Hello friends, welcome to yet another video on NISM Portfolio Management Series 21B. Many people have written to me on email asking if you have any notes on this particular module which is related to Portfolio Manager's Certification Examination, which is nothing but Series 21B. So I thought of creating a video in which I will take you through some key aspects of one chapter, and that's the reason I have selected chapter 9, which deals with portfolio management process. So how does the process of portfolio management run, and what are the key things to be looked at is what I'm going to talk about in this particular video. This is my kind of first attempt to provide certain details related to a chapter in a very crisp, concise manner. Let me see whether it serves the purpose or not. That would depend upon the kind of response that I get from this video. So what is it that I'm going to cover in this chapter? I will start with importance of asset allocation decision, uh, steps in portfolio management process, which is the second point that you can very clearly see here. Third point is need and constituents of investment policy statement. So IPS or investment policy statement is a very important part of portfolio management process. Difference between strategic and tactical allocation, and benefits and difficulties of rebalancing the portfolio. So this video will take you through key aspects of these 5 broad points. So let me start with the first point, and that is what I'm going to touch upon. So that's about asset allocation, right? Now, asset allocation is the most important thing in an investment process or in a portfolio management process. It is often very underrated, but let me tell you that if you are not able to allocate asset properly, then the portfolio will not bring the desired result, right? So asset allocation, in simple or layman's word, is the process of deciding how to distribute an investor's wealth into different asset class for investment purposes. Now, depending upon the type of investor that you are dealing with, you may allocate the portfolio, or you may allocate the wealth of an investor into separate asset classes. You may put a part of it into equity, a part of it into debt instruments, or for that matter, depending upon the regulatory permissions or regulatory prescriptions, you may also put it uh, in alternative investments, right? So when you do the allocation, which is allocation of wealth into different assets, it's very important to understand how they are correlated. And why correlation is important is because if two assets are positively correlated, then the market goes down or there is an adverse movement in the market, the portfolio will be hit badly. This is something which comes from Harry Markowitz's theory of portfolio risk and return. So understanding correlation across asset classes is very crucial in making asset allocation decisions. So you must know how are the assets correlated. Typically, what is preferred is the negative correlation between various asset classes. Now, correlation, as I have already emphasized, is the most relevant factor in reaping the benefits of risk diversification, which helps in reducing the portfolio risk. So the moment we talk about asset allocation, it's very important, as I mentioned, but when you do asset allocation, you shouldn't forget what is very important, and that is how are the different assets correlated. For instance, what is the correlation between, say, equity and, say, a debt instrument, right? So what happens when equity market goes up? How will the debt instruments behave at that time, right? So that correlation needs to be very clearly understood. So that's one important aspect of asset allocation. The second slide basically talks about what are the steps in portfolio management. So when you want to do the portfolio management, what are the things that you need to look at? how should you go in a sequential manner so that the portfolio management process works effectively, right? So first and the most important thing is development of policy statement. That is the starting point of creating a portfolio. Study of current financial conditions and forecast future trends. This is also very relevant because this relates to the entity for which you are, or the person for which you are doing the portfolio management, construction of portfolio, and lastly performance measurement and evaluation. So basically, you will work on the portfolio management process following these four important steps. Please do not forget this, and kindly make a note of this also for your exam, that you need to develop policy statements, study current financial conditions and forecast future trends, construction of portfolio, and performance measurement and evaluation also needs to be done. So what are these things? We'll discuss in detail. Now, policy statement construction that we discussed about, it relates to investment policy statement. So it can be made either by the investor or their advisors. Okay, so either of the two can draft the investment policy statement. Now, the moment you want to create the investment policy statement, you need to have certain things in mind, which includes investment objectives, goals, constraints, preferences, and risk that they are willing to take. So, investment policy statement cannot be, constructed without taking into consideration a series of factors which matter for that, right? All investment decisions are based on IPS, considering investors' goals and objective, risk, appetite. This is what kind of constitutes the core of investment policy statement. And the point not to be forgotten is that IPS needs to be revised periodically. So in the exam, you may get a question, who can prepare investment policy statement? So you must know this very clearly. It can be prepared by either the investor or the investment advisors. Having said this, we'll move on to the next slide, which talks about why do we need investment policy statement at all? I mean, what could be the reason for this? And all these points you must have in your mind very clearly, because a combination of these factors may be presented as a question in the exam. So the first point is that it enables investors to have realistic return expectation from investments. You cannot say that my investments will double, triple in 2-3 years or 5 years. You kind of work on a very realistic expectation, looking at the market scenario and various factors. You will set that expectation. It enables portfolio manager to make effective investment decisions. Now, once you have drafted your IPS, okay, now you can make investment decisions also, right? And those decisions will have to be guided by various constraints and various risk and return aspects that we had discussed in the previous slide. It provides a framework for portfolio managers evaluation with respect to the investments. So using the IPS, you can also evaluate the performance of portfolio manager. So basically, it will help you to build a framework, and you will be able to use that framework for portfolio managers evaluation. And last but not the least, it protects the investors against portfolio management inappropriate decision or unethical behavior. So the moment you have drafted an IPS, it becomes the holy book for the investment purpose, right? So we have to understand this very clearly. So when you construct a portfolio statement, you have to think about the IPS, which is nothing but investment policy statement. Let us move to the next slide. Very important aspect that also constitutes the portfolio management process is to know what are the investment objectives. And when we set the investment objectives, three important things that drive investment objectives are risk, return, and liquidity. Now, risk, return, and liquidity together would define your investment objectives. Investors may state their investment objectives in terms of desired return, in absolute or relative sense. So either you can use it against a benchmark and say that, you know, I want around 20% return compared to a benchmark, okay, or I want a return equivalent to a benchmark, or you can think about a absolute return where you don't look at benchmark or don't compare it to anything and just mention an absolute return. The desired absolute return is the return of the investment measured on a standalone basis without any comparison with any asset, right? So it's not getting compared with any particular asset class. Three main reasons for which investors invest are capital appreciation, regular income, and capital preservation. So you may get a question in the exam also, which is which of the following is our objectives for making investments. Please do not forget these 3 points, which are capital preservation, regular income, and capital appreciation. Similarly, please do not forget that there are 3 aspects that define investment objectives: risk, return, and liquidity. Now, having said this, we'll move on to the next slide. What are the different investment constraints which are there, which also need to be understood by the investors? So you may have liquidity constraints, okay, which is predominantly driven by, you know, for what time frame you want to invest, okay, and what are the asset classes in which you are investing, right? Then you may have regulatory constraints. What does regulatory constraint mean? Regulatory constraint means that if you want to, for instance, invest outside India, okay, as per the FEMA guidelines, you can only take $250,000 in a year out of India. Now that's a regulatory constraint. Okay. So regulatory constraint and liquidity constraints, okay, also, you know, put a kind of conditions, or, you know, kind of restrict the way portfolio can be managed. Okay, there could be tax constraints also, right? So, you know, how is a particular investment getting taxed, at what stage it is getting taxed, all those factors will be part of the investment constraints. Exposure limits to different sectors, entities, and asset classes. How much can you invest in one particular entity? You know, what kind of asset classes you can invest into, right? All those limits also become a constant. So, you know, constraints are kind of, you know, it's a kind of a limitation that you have, which has to be considered while you are creating a portfolio, right? Then every investor may have unique needs and preferences, right? And that will also act as a constraint for the investor. So investment constraints also become an important factor in the portfolio management process. So let us elaborate a bit of liquidity constraint, what exactly it means. So liquidity constraints differ depending upon multiple factors. Age is definitely one factor. You know, people who are younger will be ready to invest for a very long period of time and they can wait. People who are older cannot wait, so, you know, they cannot probably put their money in lock-in products. Okay, younger people usually have lesser liquidity requirement than older people. That's the general trend. Okay, so it will depend upon, the liquidity constraints will be driven by your near-term goals, emergency cash requirement, and investment flexibility that you are ready to work on. So please have these 3 factors very clearly in your mind when you think about the liquidity constraints, right? So these are, the liquidity constraint is a very important factor to consider in terms of various constraints that we have just discussed in the previous slide. Having said this, let us move quickly to the next slide, which talks about, you know, regulatory and tax constraints. Okay, so we have already said this, but let me quickly take you about this. Like insider trading. Now insider trading means nobody can use unpublished price sensitive information to trade in the market. So that's a regulatory constraint, right? Similarly, there is a constraint under LRS, which I have already told you, which is nothing but liberalized remittance scheme. Under liberalized remittance scheme, you can take maximum $250,000 out of India in 1 year. So if you want to invest outside India, you have a restriction. Tax constraints will also be there. How is the taxation of various returns being done, and which bracket you fall into? Typically, you know, for portfolio management, most of the investors will fall under the highest tax bracket only, but generally, you have to see what tax bracket an investor falls into. The next thing is related to exposure limits to different sectors, entities and asset classes. So depending upon multiple factors, exposure limits to different uh, asset classes, sectors and entities are decided. These factors could be investors' objective, risk appetite, liquidity needs, tax and other regulatory constraints. And the most important thing to be noted here is that you will be able to avoid concentration risk. Okay, so the moment you restrict your investment to a particular sector as an X percentage of total investment, you will be able to avoid concentration risk. What is concentration risk? Concentration risk means you have limited exposure to a sector. If you exceed that exposure beyond a limit, then your portfolio will become concentrated, and this will create what is called as the concentration risk. So these are very important factors when we talk about the portfolio management process. Now we quickly move on to the next slide, and in this slide, which is the subsequent slide, we'll talk about how do we assess the needs and requirements of the investors. Okay, so every investor may have different goals, and these goals are driven by time. You may have near-term goal, mid-term goals and long-term goals, right? Now the goals also have different priority. Some are very high priority goals where others may not be very important to achieve, right? So while you have goals for short term, long term and medium term, you also have to see whether the goals are equally important or they are not so important. Like buying a house may be a very important goal, right? But making a foreign trip after buying the house may not be that important a goal, right? So you have to think about how the goals are important, right? So near-term high priority goals have a very high emotional priority, which the investor wishes to achieve within, or within a few years. So when you think about portfolio management, you have to also think about this aspect of requirement of the investor. People also have low priority goals, and these goals are not particularly, if these goals are not achieved, it's not painful, right? So you will have to see which goals the investor must focus on, and the portfolio is accordingly created. Having said this, you also need to analyze the position of the investor. What is the financial position of the investor, right? This can be done by constructing personal financial statement. So personal financial statement will give you details of how the investor is placed. Okay, and you will be able to organize the data in a very systematic way. That's very important, because you will be able to list down all the assets and liabilities that an investor has, and depending upon that, you will be able to find out how is the investor placed. So personal financial statements include a statement of net worth, balance sheet and income and expense statement. Net worth is nothing but assets minus liabilities. Now once we have discussed all this, okay, we quickly move on to the next slide, in which we are talking about how to do psychographic analysis of investors. This typically one or two question comes in exam on this. So remember that you have 5 types of investors: adventurer, celebrity, individualistic, guardian and straight arrow. And now you can see their traits, right? If you are an adventurer, you are willing to take risk, you have your own idea about investments, you do not go to investment advisor, and you are confident as well as impetuous, right? So this is something which is the 4 characteristics of an adventurer investor. If you are a celebrity, you are afraid of being left out, so you want to be there in the market, you want to be in the investment world, and you want to be part of a kind of an investment process which is going on. Do not have your own ideas about investment, you will go to investment advisor, so you will take help of them, and difficult investors to deal with as they have their own confused beliefs. So who is this? This is your celebrity investor, right? Then you can have individualistic investors who are careful, methodical and analytical. Now this is very kind of unique to individualistic investors. They do their own research and tend to avoid extreme volatility. Now that's their nature. They don't want to be caught in extreme volatility. They are contrarian investors, which means their thinking is different from what the people are thinking in general, which means they take a kind of a different view, which could be opposite to the mainstream view, and they have a certain degree of confidence which they have in themselves. This is an individualistic investor. Then you have the guardian investors. Now guardian name itself talks a lot about the type of the investors. They are cautiously trying to preserve their wealth, like a guardian who protects. Then the next one is not interested in volatility or excitement, right? So this is their guardian and they want to protect the value of investments. They will obviously be not interested in that. Typically older and reaching retirement. So that's your guardian investor. And last but not the least, you have a straight arrow investor, which means they cannot be placed in the 4 categories. Composite of each of the other 4 investors, which means they have some or the other traits, okay, exposed to medium risk, and they are very well balanced and cannot be placed in any group. So please have very clear picture about these 5 category of investors, right? And remember that you will get at least one question or maybe more than one question related to this of 1 or 2 marks. So this slide is very important for you. Please take a screenshot and remember this. The next one. So what is the next one? Well, here what we need to know is that our investment life cycle that we have, it undergoes multiple phases. There is a phase of accumulation, there is a phase of consolidation, there is a phase of spending, and there is a phase of gifting. Now typically 1 or 2 questions also come with this. That's why I put it in form of a chart, right? So if you are in the phase which is the phase of accumulation, you are focused on children's education, your own house for investment, okay. Typically it has got a very long time horizon, which means in this phase you invest for a very long time period. High return, high risk, capital gain oriented investments you will make. So these are the traits of the phase of accumulation. What else? If you move to the phase of consolidation, you consolidate your investment portfolio. Time horizon will be 15 to 20 years. High capital gain investments are balanced with some low risk assets. So this is the second phase where you consolidate. Then you start spending to cover living expenses from accumulated assets. This is typically when you have reached the age of retirement. Time horizon is 15 to 20 years. Here you are dependent upon investments that generate dividend, interest and rental income. And last phase of the life is the phase of gifting, where you leave the legacy, support a charitable cause, etc. You don't have a specific time horizon and assets exceed need for spending, hence no specific objective you have. So you are well placed at this phase. I mean, this is the end of the life phase. So now you are ready to gift. So you may get questions that what kind of investments you make at the gifting phase. Do you invest in mutual fund or do you invest in debt instruments? Okay, that kind of question may also come related to this. The next is portfolio benchmarking. What does it mean? So, every portfolio has to be benchmarked. So investment policy statement needs to provide a framework for evaluating the performance of portfolio. So it is very important that you should have it in place. It will typically have a benchmark portfolio which matches the composition of investors' portfolio. So whenever you select a benchmark, it's very important that the benchmark correctly represents the portfolio and it mimics the portfolio. The idea is to compare apple with apple, which means benchmarking is very important so that you will get to know how is your portfolio and how is the benchmark and whether they are same or not. As per AppMe, while tagging an investment approach to a particular strategy, the portfolio manager shall select one benchmark from those prescribed for that strategy to enable the investor to evaluate relative performance of portfolio manager. Now it's very clear from this that you need to benchmark, because you will be able to identify how is the performance of portfolio manager. The next part is your asset allocation decision, how you allocate your assets, right? So asset allocation decision follows logically from investors' needs and goals, risk preferences and liquidity needs. After developing a forecast on risk and return of various asset classes, the portfolio manager has to decide the mix of assets that maximize the after-tax return. So you have to take into consideration various aspects of return, risk and return. And once you have taken that into consideration, you will create the portfolio. Now we have kind of moved to the last part of this chapter. So you can do strategic asset allocation and tactical asset allocation. These are two types of asset allocation. Strategic asset allocation is long term, tactical is short term. Now you must have this differentiation also. In strategic asset allocation, you focus about how much time you will be in the market. In tactical, you time the market. Please understand this difference, very interesting difference that you have. So strategic about how much time you want to be in the market, and tactical about when you want to enter the market. Strategic asset allocation, or SAA, is designed to meet the investor's goal and objective over a longer period of time, while tactical asset allocation is to take advantage of opportunities in the financial markets. So in this particular video, which has around 30 minutes, what I have done is I have given you a broader overview of what all things you should focus on in chapter 9 of portfolio management series 21B of NISM. I hope this video has helped you. Please do share your feedback so that I can prepare similar videos for your reference. Thank you.